Hello, I'm Richard Mize, real estate editor for the Oklahoman and newsok.com, talking with David Dirkschneider, a multifamily property broker with Price Edwards and Company here in Oklahoma City. We're going to be talking about his fairly fresh off the press 2017 multifamily property market summary. So I wanted to talk about construction today at first.
Sure.
Why the slowdown?
You know, I think the slowdown's for a couple reasons. One, construction prices have steadily increased. You know, the demand was there on the rental side. There was a lack of housing in Oklahoma for a long time, and there's still relatively kind of a lack of
rental housing.
A lack of rental housing,
right.
Correct. And so, you know, just like any time in the past, I mean, when there's a need for something, people jump on, but in the commercial real estate market, when people jump on, they jump all the way in, and they kind of just went a little overboard for a little while. And so the demand now is just, there was a surplus of inventory that was added. You know, prices, the investment market on the sales side heated up, and so when people weren't able to find the return on existing properties, they started building, and you know, and it was hot and good for a while, but you know, kind of it went a little too fast for our size of a market.
And the way this works is, if it was overbuilt, it was overbuilt 4 years ago, and it takes 2 or 3 years to slow down. Correct. Plans, because these are huge projects.
Yeah.
And the construction timeline is pretty long, right? So are we seeing some stuff finished right now that was a great idea 4 years ago that's not so great of an idea now?
That's exactly it. You'll have, you take a HUD project, for example, where somebody uses HUD financing, and you know, you can work on that for 2 years, sometimes even more, before you even break ground. And so, you know, and you may have $1 million invested into it before you start. And so at that point, you're pretty much all in. And so now those projects where people are already all in, even though the market was overbuilt, as a lot would say, they still have to finish those out.
It's also been in pockets of price range and target market, as well as geographic pockets. The south side had a good little pocket, as usual. The north side of Coil Springs area had a good little pocket, and downtown had a good pocket.
Correct.
Lots of construction and lots of upscale construction. How do you think that is part of what? How do you think that affected the overall rent average increase, which increased despite all this product coming on the market?
Sure.
Slightly less than your 30-year average, but still there was an increase year over year last year. Is that why? Because
there's no question that the new inventory added to the rent increase. I mean, the properties that they're building now, in order just to make them cash flow, they have to be kind of premium market rentals. They're pushing, I've even seen some properties now hitting $2 a square foot on some units, which is, you know, 5 years ago would have been unheard of in this market. And so there's no question that those did help push the numbers up. I mean, I wouldn't say that those alone push the average rents up, just because, you know, there's roughly or just a little under 100,000 units in the market, and you know, if you added a couple thousand units a year, those aren't going to change it too much, but they do definitely impact it. You know, with construction prices, you have to get those rents in order to justify building. Do
you think we filled up the hole? I mean, there was no apartment construction here from the bottom of the 80s bust until the mid 90s, and then very little until after the turn of the millennium, and it really didn't actually pick up full speed until
mid-2000s,
7 or 8 years ago.
Yeah.
Are we caught up, do you think?
You know, personally, I think we could continue to build this pace and be okay. You know, in select areas, like you said, the I-35 corridor, kind of more area, Coil Springs Mall, and the urban core got a little overbuilt. I mean, it was, you know, when you have a couple thousand units getting put into such a small area in a relatively short period of time, it's going to affect the other inventory in the area, where they have to increase their concessions and entice people to come in. But you know, if that same level of construction, I think, you know, let's call it 1,500 to 2,500 units a year, continued, I think Oklahoma could easily absorb it, just with our migration, and you know, it's now people are wanting to stay in Oklahoma, and so that younger demographic, especially, they're renting more, and I think we could easily absorb that number of units if they were well located and not just all in one location.
Are the north side and the south side residential communities, and I mean in the broad sense, not just this property versus that one, are they? They're sustainable, aren't they? See, one of the biggest surprises to me, actually, in some ways, is that downtown has become its own town now. I mean, even with the vacancies in office, even with the changes in the dynamics, and slowed down, the dynamics are not as hot as they were here 2 years ago. But people aren't moving because their lives are here.
Yeah.
I mean, we still need a grocery store. Oh, gods of grocery stores.
It'll eventually happen.
But there's like 8,500 people that live in downtown Oklahoma City now, which is just remarkable.
Yeah, compared to 10 years ago, I never thought that.
But it's going to sustain, I think.
I think so, and I think we're close to being able to justify a grocery store. You know, the hard thing is, even with 8,500, if every person down here shopped at that grocery store, it's probably not enough for them to justify it, but it's getting close. But I think downtown's sustainable. You know, I think the biggest factors is jobs. I mean, the number one driver of apartments is jobs. You know, they're close proximity of jobs, and especially downtown, well-paying jobs. You know, when the oil market kind of slowed down, you know, it hurt the housing market here, because if you look at the average income of renters, and we'll take the Edge for example, they've got numerous renters that are over $100,000 annual income, which you think, well, why would that person buy or rent an apartment versus buy a house? And it's because they choose to. And so when those jobs, those high-paying jobs, especially with a lot of the oil companies, and when they slowed down and pulled back, it hurt the urban core. But it's still sustainable, especially as those jobs add.
It's kind of an odd bifurcation there. The high rent renters rent because they can afford to, and a lot of the low rent renters don't buy because they can't afford to. It's just interesting.
No, it is an interesting dynamic.
Talk about what I call the renter-friendly single-family housing market and how it affects development and construction of apartments. And by renter-friendly, I mean for 10 years now, if you didn't have the credit, the tightened standards kept you from being a home buyer. Well, that's kind of changing. That's easing up, but now here come higher interest rates again.
Yeah.
So do you see continued demand for rentals just based on that?
I mean, I think going forward that there's a demand for both. I don't really see, if somebody rents an apartment or somebody rents a house, I think a lot of times they're a different either demographic or household.
Different stages of life.
Exactly. Yeah, I mean, look at myself. I'm married with kids and you know, several kids, and so I don't know that I would want to live in an apartment, especially at the young age, you know, running around, and I'd rather have a yard. Where, you know, somebody that doesn't, or maybe they have 1 or 2 kids, they like the apartment. They don't want the maintenance or the hassle of mowing a yard. I think they're two different demographics, but I think both will continue to be strong going forward. I mean, especially with the transient lifestyle and people wanting to be able to pick up and move, or a job in another city, you know, becomes available. Having a home a lot of times ties people down for a certain period of time, where, you know, if you're renting, you can put in your notice and be gone.
Yeah, lock and leave. Lock and leave has become a thing, right?
Whether it's a
single family home or a garden home or a condo.
And it's attractive. I mean, I would love to be able to just lock my door and leave for a month if I wanted.
Yeah. Anything to add, again, about anything to do with the multifamily market, whether it's construction or investment sales or whatever?
Yeah, you know, I just think that, you know, I think we've had a good run, you know, and going forward, I think that, you know, you're seeing a lack of deals to buy. I mean, prices have heated up quite a bit, and you know, as you talked about with interest rates going up, it's harder to find deals that pencil out. And so I think going forward, it'll be interesting to see if we can keep up the volume that we've had the last few years. You know, initially we were pretty bullish, but as we see just the interest rates creeping up, it's harder and harder to make those deals work.
That and the value add thing is about played out, hasn't it? I mean,
it is.
Isn't it pretty much everything that could have been bought and improved and turned?
Well, exactly. You know, and everything you see on the market says value add. I mean, every listing that comes out always has value add play on it, and so it's interesting. Everybody has a different perspective of value add. You know, but one thing I think that's interesting, and it goes to the point of, are there any left? I think there are. I mean, if you look at just construction in general, so between 1960 and 1985, we built about 65% of our entire inventory during that time. Well, between 1985 and 2010, there was only about 10% of the inventory, and then since then we've built about 25%. And so what that has caused is a gap in affordability for nice products. So you got the stuff that was built in the 60s, 70s boom, and then some of the early 80s. A lot of that inventory has just gotten deteriorated. You know, there's a lot of deferred maintenance, but yet there's people that make a decent income. They don't want to live in those older properties, but they can't quite afford the new luxury properties. As I said, I mean, at $2 a foot, I mean, that means a 2-bedroom apartment's, you know, $1,500. They can't afford that. So I think that huge gap is in that that middle range product. And I think there's, but the hard part is finding them.
And some people like to spend their money on something besides a roof over there.
That's true. I mean,
luxury is in the eye of the beholder as well.
Yeah, they say you're supposed to spend 30% of your income on housing, and so if you're making $50,000 a year, you can't really afford $1,500 per month for rent.
Amen.
Yeah.
Thank you, David. I'm talking with David Dirkschneider, multifamily property broker with Price Edwards and Company here in Oklahoma City, in his fresh off the press multifamily market report, which is available online at priceedwards.com. Is that right?
That's correct.
All right. I'm Richard Mize, real estate editor for the Oklahoman and NewsOK.com.